Hello everyone, welcome back to Fundrise Finance. It has been a brutal April so far for the markets, with the S&P 500 falling almost 9% just in the month of April, and year to date it has fallen almost 13%. So as we speak, the S&P 500 is in a correction territory. Back in the middle of March, when Fed had announced its rate hikes, we started to see a small rally, and everyone was so optimistic about. But in the last few weeks, we have seen all that rally fizzle out and we are down to the bottoms that we had seen early March. The Nasdaq has fared much worse than the S&P 500. It is down more than 21% year to date, which means it is in the bear market territory now. The Dow Jones is teetering very close to the correction territory. It is down just over 9% year to date. In all this doom and gloom, as a dividend investor who is more invested into a dividend paying ETF than choosing individual stocks, the ride so far in 2022 has not been that great. Here we see the popular dividend ETF SCHD falling more than 5% year to date, which, if you look at the positive side, has done much better than the S&P 500, which is dominated by all the high-flying tech stocks, few of which have taken a massive correction. In today's video, I want to go over 15 of the highly invested dividend ETFs and see how they have performed year to date in this doom and gloom environment. To begin with, we have the ever popular VIG, which is the Vanguard Dividend Appreciation Index Fund that was launched way back in 2006 and has almost $65 billion invested into it. Then we have VYM at almost $45 billion. Then we have the current popular favorite, SCHD, with almost $35 billion. Then we have DGRO, which is the iShare Core Dividend ETF with almost $23 billion. Then we have DVY, which is the iShare Select Dividend ETF with just over $22 billion. Then we have SDY, Nobel, HDV, DJRW, SPYD, SPHD, FDL, FDVV, PEY, and DHS. And as most of the dividend paying companies fall into the value category of the market, I've also included VTV, which is the Vanguard Value Index Fund, just for discussion purposes, into this mix. Also, I've added JP and DEVO, the two ETFs which are very well known for paying high dividends and also generate value through covered call writings on their portfolios. So overall, we have 18 ETFs to look at. When we look at the overall data for each of these ETFs, we can see that all the popular highly invested dividend ETFs have very less expense ratios. When we sort these ETFs based on year-to-date performance, we can see VIG has fallen the most, at almost 9.5%, followed by DJRO just over 8%, and JP almost 6% down year-to-date. Likewise, when we go down the list, we can see the best performing ETF of this list year to date has been DHS, which is the Wisdom Tree US High Dividend Fund, is almost 5% returns year to date, followed by SPHD, giving a return of almost 4.5%. These two ETFs are actually monthly paying ETFs, and these are popular among the investors who like to see dividends rolling in every month. One common trait about all these ETFs that have generated good returns year to date is they target high paying dividend companies which mostly fall into your energy sector that has done really well this year because of the oil prices shooting up due to the war between Russia and Ukraine. If you look at the top 10 holdings of DHS, we can see ExxonMobil and Chevron taking almost 12 to 13% of the portfolio. And we can see here, both of these companies have delivered almost 30% returns year to date. And that reflects into all those ETFs which have these two companies into their top holdings. We can see a similar trait like this in SPHD also, which has Williams Companies, Kinder Morgan, and Chevron Corporation as part of its top 10. Similarly, HDV has ExxonMobil and Chevron Corporation in its top 10. So I highly doubt if these ETFs can sustain this performance and the oil prices will start to normalize. Another way to look at this data is by sorting them based on how much of the holdings are concentrated in the top 10. So we can see here FDL ETF has 58% of its holdings concentrated in the top 10, followed by Devo, it's almost 55%, and that's followed by HDV, which has almost 53%. On the other side of the spectrum, we have SPYD, which has 15% in its top 10. Because SPYD is basically an equal weighted ETF of its holdings. So those ETFs, which normally follow these rules of equal weighting, see this top 10 having less percentage compared to those ETFs which are based on market cap So even an ETF like ACHD was almost 40 plus percent in its top 10 holdings. But ACHD has been a marvelous performer over the last 10 years. So as long as the stocks selected are good, top 10 holdings being on a higher side, though a risky one, should do good in the long run. And SCSG has really done well in the past. You can see here the last 5 years, it has the best performing ETF, giving on 71.38%. So when we sort this list based on the 5 year performance, SCSG comes right on top, followed by DGRW, then VIG, DGRO, and NOBL. So if we highlight these being the best performers of the last 5 years, and when this list is sorted by the last 1 year, we can see all of these ETFs are performing fairly poor and are at the bottom of the list. But like I said earlier, all the last 1 year or year to date good performers are highly invested into the energy sector, and that joyride will not be lasting for too long. Let's say we still highlight them as the top performers of the last 1 year. And when sorted by year to date, we can see the same performing the best even year to date. And when sorted by the dividend yield, we can see JP being the topmost at 7.95, followed by DEVO at 4.92. Anyway, these two ETFs are meant for income seeking investors, followed by SPYD, DHS, PEY, for which I would say the dividend is fairly high. So let's say if we ignore the income ETFs and just highlight the ones after that, the topmost, that would be SPYD, DHS, PEY, SPHD, and FDL. Now, when the list is sorted based on the expense ratio, we can see quite a few bunched up at the top, and that to less than 0.1%. If we highlight all of these, next, when we sort these holdings based on the top 10 percentage, and here if I consider only those ETFs which have less than one third of the entire portfolio into the top 10. So let's say if I have a cutoff at 30%, I have all these ETFs. With all of the ETFs highlighted, one thing that we can observe here is none of the ETFs have each of the categorization highlighted. If you look at SPYD, it has top 10 holdings, which is good. The yield is very high. The expense is low. Year to date and last 1 year, it has performed really well. But last 5 years, it has not been that great. Same applies to SPHD, which has top 10 is good. The yield is 3.65. Year to date is good. Last one is good. At last 5 years, not at all good. So what this shows is that though we have a buffet of choices available, we have to be very careful in choosing the ETFs that we want to see in our portfolio. Back to sorting them based on the assets managed. Here we can see why VIG, VYM, SCHD, and DGRO have so much invested into them because they have been consistent performers over the last many years. Yes, the last 1 year and year to date has not been good for this, but the whole market overall has not been good. It has been very choppy. But as the dividend investors, we are not buying today and selling them tomorrow. No, we are buy and hold investors. We hold quality portfolio of stocks and ETFs and cherish the returns they give. We cherish the dividends we get every month or quarter. That's a true sign of a disciplined dividend investor. We don't care if the market is up or down. And if a good stock or ETF is on sale, we grab it. We like to see days which are red and make use of that opportunity to add more such shares of an ETF or a stock into our portfolio. I personally have these ETFs highlighted in blue in my portfolio. I really feel good having them in my portfolio, giving me consistent returns and dividends, and I will continue investing into them whenever the market is up or down. If it is down, well and good, I get to buy more of these. And I hope the ETFs that you have in your portfolio are doing good and you cherish them having in your portfolio. I hope this video has been good and has given some valuable information to you. I would really appreciate if you could hit that like and subscribe buttons and hit that bell so that you don't miss a single video packed with valuable information just like this one. That'll help grow this young channel. So until we meet in our next video, let's try to do as much as possible to be financially healthy. See ya. Bye.